Picture this. The stock market plummets, your portfolio value shrinks, and panic sets in. What if I told you that the key to surviving and even thriving during economic uncertainty lies in a few strategic moves? Today, we're uncovering the top 10 strategies that could safeguard your investments and help you navigate through the storm. By the end of this video, you'll be equipped with the tools to not only protect your wealth, but potentially grow it during volatile times. So, buckle up as we count down from 10 to 1 the most effective investment strategies for uncertain economic times. Hit that subscribe button and let's secure your financial future. 10. Diversify your portfolio. Diversification is the cornerstone of any solid investment strategy, but it becomes even more crucial during periods of economic uncertainty. The basic idea is to spread your investments across various asset classes, stocks, bonds, real estate, commodities, and even cash, so that your overall portfolio is less vulnerable to a downturn in any one area. When markets are unstable, some sectors might perform poorly, while others remain steady or even grow. For example, while the stock market might be volatile, bonds and precious metals like gold often serve as safe havens. By diversifying, you reduce the risk of a significant loss, as the gains in one area can offset losses in another. It's like not putting all your eggs in one basket. If one basket falls, you still have others to rely on. 9. Focus on defensive stocks. Defensive stocks are a key component of a resilient investment strategy, particularly during times of economic uncertainty. These stocks belong to companies that operate in sectors providing essential goods and services, industries that people rely on regardless of economic conditions. Common sectors for defensive stocks include healthcare, utilities, and consumer staples. Healthcare companies provide critical medical services and products which remain in demand even during a recession. Similarly, utilities like electricity, water, and gas are essential for daily life, ensuring that companies in this sector continue to generate stable revenue. Consumer staples such as food, beverages, and household items are also necessities that people purchase regardless of economic conditions. The stability of defensive stocks stems from their consistent earnings and dividend payments. These companies tend to be well-established and financially sound, making them less susceptible to the dramatic fluctuations that can impact more cyclical stocks, which are tied to the overall economic cycle. While defensive stocks might not deliver the high returns seen in more volatile sectors during a booming economy, their primary value lies in the stability they provide during downturns. By investing in defensive stocks, you can mitigate the risk of significant losses in your portfolio, helping to preserve your capital and provide a reliable income stream through dividends. 8. Build an emergency fund. Having cash on hand to cover unexpected expenses or to take advantage of investment opportunities. Building a substantial emergency fund is critical, especially when economic conditions are shaky. An emergency fund should ideally cover 3 to 6 months' worth of living expenses. This fund acts as a financial safety net, preventing you from having to sell investments at a loss to cover unexpected costs. Moreover, having liquid assets allows you to capitalize on investment opportunities that may arise when the market is down. By keeping a portion of your portfolio in cash or cash equivalents, you maintain the flexibility to adapt to changing market conditions. 7. Invest in bonds and fixed income securities. Bonds and other fixed income securities are generally considered safer investments compared to stocks, especially during times of economic uncertainty. These investments provide regular interest payments and return the principal amount at maturity, making them a more predictable source of income. Government bonds, in particular, are viewed as low risk because they are backed by the government. Corporate bonds, while slightly riskier, can offer higher yields, especially if they are from companies with strong credit ratings. Including bonds in your portfolio can provide a steady income stream and reduce overall volatility. 6. Consider dividend-paying stocks. Dividend-paying stocks can be a reliable source of income during economic downturns. Companies that consistently pay dividends tend to be well-established, financially stable, and capable of weathering economic storms. These stocks offer two potential benefits: regular income through dividends and the possibility of capital appreciation. Moreover, during periods of market volatility, dividend payments can provide a return even if the stock price remains flat or declines. Reinvesting dividends can also compound your returns over time, increasing the overall growth of your investment. 5. Hedge against inflation. Inflation can erode the purchasing power of your money over time, making it a significant concern for investors during uncertain economic periods. One way to hedge against inflation is by investing in assets that tend to increase in value as prices rise. Real estate, commodities like gold and oil, and inflation-protected securities, such as TIPS, Treasury inflation-protected securities, are common inflation hedges. Real estate investments can generate rental income and appreciate over time, while commodities often rise in value when inflation increases. 4. Maintain a long-term perspective. One of the biggest mistakes investors make during economic uncertainty is reacting to short-term market movements with panic-driven decisions. It's essential to maintain a long-term perspective and avoid making impulsive changes to your investment strategy. Markets are cyclical, and while downturns can be stressful, history shows that they are often followed by periods of recovery and growth. By focusing on your long-term financial goals and sticking to your investment plan, you can ride out the turbulence and potentially benefit from the market's eventual rebound. Remember, investing is a marathon, not a sprint, and patience is often rewarded in the long run. 3. Stay informed and adapt. Economic uncertainty requires investors to stay informed about market trends, economic indicators, and global events that could impact their portfolios. However, it's not just about staying informed, it's also about being adaptable. The investment strategies that worked in a stable economic environment may not be as effective during a downturn. As conditions change, be willing to reassess and adjust your investment approach. This might mean reallocating assets, shifting to more defensive investments, or taking advantage of new opportunities that arise from the economic climate. Staying flexible and informed allows you to make proactive decisions that align with the evolving market conditions. 2. Avoid high-risk investments. During times of economic uncertainty, it's wise to steer clear of high-risk investments. While these may offer the potential for high returns, they also come with a greater chance of significant losses, something you want to avoid when the market is volatile. High-risk investments include speculative stocks, high-yield bonds, and emerging market equities. These assets are more likely to experience dramatic price swings and may not recover as quickly as safer investments during a market downturn. Focusing on more stable, low-risk investments can help preserve your capital and reduce stress during uncertain times. 1. Consult a financial advisor. Finally, when navigating economic uncertainty, there's no substitute for professional advice. A financial advisor can provide personalized guidance based on your unique financial situation, risk tolerance, and investment goals. They can help you create a diversified portfolio, manage risk, and make informed decisions that align with your long-term objectives. A financial advisor can also provide emotional support, helping you avoid making panic-driven decisions during periods of market volatility. By working with a professional, you can develop a comprehensive investment strategy that positions you to survive and potentially thrive during economic uncertainty. From diversification and defensive stocks to staying informed and consulting a financial advisor, these top 10 strategies can help you navigate the challenges of a volatile market. Remember, the key to surviving and thriving during economic uncertainty lies in preparation, patience, and adaptability. So, what are your strategies for investing during uncertain times? Share your thoughts in the comments below, and don't forget to subscribe for more insights on how to manage your finances in a changing world.